Welcome to this explainer. An unadjusted trial balance can actually create a pretty dangerous illusion. It hides a company's true financial reality right behind raw cash numbers. So today, we're going to look way beyond the surface. We'll see exactly how essential year-end adjustments literally rewrite the bottom line. It's really the ultimate financial question. Does the raw cash sitting in the bank actually reflect the health of a business? Well, it is incredibly easy to see a massive cash balance and just assume, hey, this company is thriving. But those raw, unadjusted numbers, they might just be lying to you if the proper year-end entries haven't been made.
Here is our agenda for uncovering the true financial picture today. 1. The accounting reality check. 2. Depreciation, wear and tear. 3. The cost of uncollected debts. 4. Timing is everything, accruals. And 5. Finalizing the financial picture.
All right, diving right into Section 1, the accounting reality check, moving beyond the trial balance. So here's the thing you've got to remember. Year-end adjustments, they aren't new transactions. They're actually non-transactional corrections, and we make them at the very end of the accounting cycle. Why? Because economic realities shift over time, so we have to fix errors and update accounts to reflect the true status before we post any closing entries. This ensures we align revenues and expenses accurately to the exact period they belong in, which gives us a completely true picture of the financial statements. Moving right along to Section 2, depreciation, wear and tear, uncovering invisible asset decay. Okay, so we track this invisible decay in two primary ways. The straight line method is super simple and predictable. You're just writing off an equal percentage of the original cost price every single year. But contrast that with the diminishing value method. Here, the percentage is written off based on the declining book value. Basically, it represents a much more aggressive early write-down of an asset's worth. Now, the mathematical difference becomes pretty stark when you actually play it out. Let's look at a cost price of R500,000 with a 20% rate over 4 years. Straight line? That's a constant R100,000 hit year after year. But look at diminishing value. It scales down. 100,000, then 80,000, 64,000, all the way down to 51,200. By year 4, your final book value looks completely different. This adjustment directly dictates what your equipment is actually worth on paper. Section 3. The cost of uncollected debts, ghost revenue. So there is a fundamental difference between just preparing for credit losses and actually facing them. Think of a bad debt reserve as a protective shield. It's an estimated amount of receivables a company wisely assumes, yeah, we probably won't collect this. Bad debt, on the other hand, is the harsh reality. That's loaned money officially written off as uncollectible. If you don't adjust your accounts for these estimated credit losses, your expected revenue, it's just a ghost. And listen, this absolutely isn't just some academic exercise. Take African Bank, for example. They crashed into a massive loss when more than a third of their customers missed months of payments. When a business fails to properly account for and adjust its allowances for credit losses, the resulting ghost revenue can literally bring down a major financial institution. It's a real game changer. All right, on to Section 4. Timing is everything. Accruals. Recording reality over cash flow. The whole idea of the accrual basis forces us to record revenues and expenses as they are earned or incurred. We're totally disregarding when the actual cash moves. Alongside prepaid expenses, where we pay for items in advance, accruals act as the absolute only way to get a highly accurate, real-time picture of economic activity. Let's put this into perspective. Consider buying R10,000 worth of stationery. If you pay the invoice immediately, well, the cash leaves the bank and the transaction is recorded. Pretty simple, right? But what if you bought the stationery, you haven't received the invoice yet, and the cash hasn't even left the bank? This is where our reality check kicks in. Under the accrual method, you must record that expense right now. Without this accrued expense adjustment, your profit is just artificially inflated. And finally, Section 5, finalizing the financial picture, the ultimate statement. It's only after applying all our adjustments, calculating that depreciation, establishing reserves for credit losses, and locking in the timing of accruals and prepaid expenses that we can actually build a finalized statement of financial position. As you can see, total assets perfectly balance against equity and liabilities. Without adjustments, this whole thing is just a cash-based illusion. But with them, it's rock-solid reality. So what should you take away from this explainer? Let's wrap it up. Adjustments fix the illusion of raw cash flow. Depreciation maps true asset value. Allowances protect against ghost revenue from credit losses. And accruals
along with prepaid expenses, well, they lock in exact real-time economic activity. Without these fundamental steps, a business's true financial health remains completely hidden.
Which leads me to one final thought for you. If you aren't adjusting your financial reality, whose illusion are you buying into? It's definitely something to ponder the next time you look at a company's bottom line. Thank you so much for joining this explainer. Keep questioning the numbers, and we'll see you next time.